Have you ever noticed that the money we use every single day moves within a system far different from what it appears to be? And when you think about why prices keep changing, what if I told you that the real reason lies in a completely different mechanism at the center of it all? Although the relationship between interest, the credit system, and the market economy seems complex at first glance, it actually rests on a very simple truth. When money stops being just a medium of exchange and turns into a tool of control and dominance, the economic behavior of both individuals and societies changes fundamentally. Welcome to History of Economy. We'll explore the deep connections between money, power, and history. And remember, nothing is as simple as it seems. At the heart of the modern economy lies the system of debt. Money today is mostly based not on a real value, but on a promise that is expected to be fulfilled in the future. The credits created by banks form the core of this system. Banks do not use existing savings to issue loans. Instead, they create new money. Although this process seems to create short-term activity by adding new money into the market, it actually lays the foundation for long-term price instability. The real issue does not stem from the existence of credit itself, but from the structure that operates through the interest mechanism. Interest not only increases the amount of debt, but also creates a hidden force that influences price changes in the market. Every loan comes with an interest obligation, adding a debt burden that the system cannot fully cover. The money created is always less than the total debt expected to be repaid, which introduces an unavoidable gap into the economy. This gap drags the economy into an endless cycle of borrowing, and a system that stands on debt can survive only through constantly creating new debt, which brings new interest. As interest rates rise, both producers and consumers face growing pressure. Producers must borrow to continue producing, and consumers must borrow to maintain their consumption. In such an environment, keeping prices stable becomes nearly impossible. Therefore, inflation is not an independent event or merely a result, but an inevitable byproduct of a debt and interest-based system. When a producer takes a loan to expand their business, the interest cost increases total production costs. The producer has no choice but to reflect this additional cost in the final price of their products. As a result, almost every product enters the market already carrying a built-in financial burden. Faced with rising prices, the consumer either tries to increase their income or turns to credit to meet their needs, and this choice triggers the same cycle again. More credit, more interest, higher prices, and a new need for credit. In trade, value is mutual, and the exchange occurs under equal conditions with a tangible transfer of goods or money. But in an interest-based transaction, one side earns without effort or risk. This transforms the system into one that seeks profit from money itself rather than from real production. As a result, a growing gap emerges between the real economy and the financial economy. The modern market economy presents price increases caused by monetary expansion as if they were normal and inevitable. Yet most of these price increases do not come from production costs, but from the endless expansion of money through credit. This expansion creates no real wealth, only inflated numbers. In the end, society's purchasing power declines, income distribution deteriorates, and the economy becomes more fragile. Within such a system, it is hard to claim that individuals make economic decisions with complete free will. The interest-based credit structure pulls people into an invisible mechanism of influence. People begin to act not according to their real needs, but according to the conditions imposed by the debt cycle. This effect is not limited to individuals. It surrounds states and large corporations as well. As states borrow, their economic policies begin to align with the expectations of their creditors. Thus, the interest-based financing system goes beyond money and influences the entire social and political order. This structure constantly pressures producers while elevating those who earn through capital without taking risks. The producer takes risks to earn. The one who lends earns without taking any risk. This damages economic justice and expands the income gap, As the gap grows, social tension rises, the middle class shrinks, and people become more vulnerable to market fluctuations. Ultimately, the root problem of the modern economic system is that credit combined with interest becomes a top-down mechanism of control over the entire market. The interest-based debt model negatively affects production, consumption, prices, income distribution, social justice, and economic stability all at once. The solution is to return to the true spirit of trade, a system where value is created through real production and genuine exchange. In such a system, money becomes a tool again, not a goal, and the economy is built on production, labor, and fairness instead of debt. If this lit a light in your mind, subscribe. History holds the answers that make things easier. I'll show you.